It is January 8, 2026. Remember the Great Resignation? Remember when you could walk into your boss's office, demand a 20% raise, and if they blinked, you could walk across the street and get a 30% raise from their competitor before lunch? Those days aren't just over. They are dead and buried. We have just received data that changes the entire trajectory of the American economy for the rest of this year. The leverage has officially shifted. For years, we tracked the ratio of job openings to unemployed workers. At the peak of the madness in 2022, there were 2 jobs for every single unemployed American. It was a worker's paradise. Today? That ratio just crashed through the floor. It is now 0.9. There are now more unemployed people than there are job listings. The music has stopped, and for the first time in 5 years, there are not enough chairs. But here is the twist that should terrify every investor watching this: companies aren't firing people en masse yet. They are doing something much more insidious. They have initiated a silent freeze. And historically, this specific behavior is the calm before a massive storm in the S&P 500. In this video, we are going to dissect the latest JOLTS report and what it means for your portfolio in 2026. We're going to look at why the Federal Reserve's rate cuts in late 2025 might have been too little, too late, and why your strategy for stocks and real estate needs to pivot right now. Buckle up. The labor market isn't just cooling, it's freezing over. Let's get right into the numbers that dropped this morning, because the mainstream media is glossing over the severity of this. The Bureau of Labor Statistics released the JOLTS data, that's the Job Openings and Labor Turnover Survey, for November. Wall Street was expecting a number around 7.5 million. The reality? 7.15 million. That is a massive miss. But what's worse is the trend. We are looking at a more than 1-year low. And just to add insult to injury, they revised the previous month's numbers downward. This is a classic pattern we see in every recessionary lead-up. The data comes out bad, and a month later, they tell us, oops, it was actually worse than we thought. But the raw number of 7.15 million doesn't tell the full story. You have to look at where these jobs are disappearing. We are seeing a massive pullback in leisure and hospitality. Why does that matter to your wallet? Because that is the excess spending sector. When Americans feel rich, they eat out, they travel, they stay in hotels. When businesses stop hiring waiters and hotel staff, it's because their forward-looking bookings are drying up. It is the ultimate leading indicator of consumer confidence. We also saw drops in transportation and warehousing. Think about that. We are in a post-holiday season window. If logistics companies are pulling back on hiring, they are betting on a slowdown in the movement of goods. That is a direct red flag for earnings reports coming out later this month for retail giants like Amazon, Walmart, and Target. And perhaps the most concerning, healthcare and social assistance. This sector is usually bulletproof. People get sick whether the economy is good or bad. When you see hiring freezes hitting the healthcare sector, you know the rot has gone deep into the system. Now, I know what some of you are thinking. But Jake, I looked at the headlines, and layoffs are down. Isn't that good news? This is the trap. This is exactly where retail investors get slaughtered. Yes, the JOLTS report showed layoffs declined to a 6-month low. On the surface, that sounds bullish. It sounds like companies are strong. But you have to look at the hires number. Hiring has collapsed to its lowest level since mid-2024. This phenomenon is what economists call labor hoarding. Here is the psychology of the CEO in 2026. They remember the trauma of 2021 and 2022. They remember how hard it was to find talent. They remember paying recruiters $30,000 fees just to find a mid-level manager. So, even though their business is slowing down, they are terrified to fire people. They don't want to pay severance, and they don't want to risk needing those workers again in 6 months if the Fed sticks the landing. So, what do? They don't fire. But they don't hire. They engage in attrition warfare. When Susan from accounting retires, they don't replace her. When Mike in sales quits to move to Texas, they just split his workload among the remaining 3 guys and tell them, work harder. This creates a stagnant, paralyzed labor market. It's a silent freeze. Why is this dangerous for the economy? Because job switching is the #1 driver of wage growth. The only way the average American gets a real pay bump, one that beats inflation, is by jumping ship to a new company. If hiring stops, job hopping stops. If job hopping stops, wage growth flatlines. And if wage growth flatlines while inflation is still sticky above 2%, consumer purchasing power evaporates. This is the death spiral for corporate earnings. Let's talk about the Federal Reserve. The grand architects of our monetary destiny. In late 2025, the Fed finally pivoted. They cut rates at the final 3 meetings of the year. The market cheered. Everyone thought, here we go, cheap money is back. But here we are in January 2026, and the engine is sputtering. Why? Because monetary policy acts with a lag. It takes 12 to 18 months for a rate cut to actually ripple through the plumbing of the economy. The cuts they made in December won't be felt in the real economy until mid-2026. But the labor market is cracking now. And here is the nightmare scenario for Jerome Powell and the central bankers: Stagflation Lite. The data shows that while the labor market is cooling, inflation is stubbornly holding above their 2% goal. This puts the Fed in a straitjacket. If they panic and cut rates aggressively to save the job market, they risk reigniting inflation, sending the cost of living skyrocketing again and destroying the bond market. If they hold rates steady, which is what the consensus expects for later this month, they risk letting this silent freeze turn into a deep freeze. The Fed is watching that ratio, 0.9 vacancies per unemployed worker, very closely. They wanted to cool the market down from the 2-to-1 ratio. They wanted balance. But economics is not a precision instrument, it's a sledgehammer. They swung the hammer to kill inflation, and they might have just shattered the labor market. Now, we have to address the elephant in the room: data quality. We have a serious divergence in the numbers, and this uncertainty creates volatility. On one hand, we have the government's JOLTS data saying the sky is falling. Vacancies down, hiring dead. On the other hand, we have ADP research saying hiring rose at a moderate pace in December. We have the Institute for Supply Management saying services activity expanded at the fastest clip in a year. What is going on here? First, realize that the JOLTS survey has a terrible response rate. Fewer and fewer companies are actually filling out these government forms. So the data is noisy. Second, the ISM data shows a K-shaped economy. The service sector, specifically the high-end services, is still moving. But the industrial and lower-end services are contracting. And then there is the Indeed data. The job posting site shows listings rebounded slightly in November. So, is the market crashing or rebounding? Here is my take: watch the trend, not the noise. The ADP numbers are often revised heavily. The ISM is a sentiment survey, it asks managers how they feel, not what they actually did. The JOLTS data, despite its flaws, tracks the raw mechanics of openings. And the undeniable trend across all metrics over the last 6 months is a slowdown. The direction of travel is down. The only debate is the speed of the descent. Okay, let's bring this home. Why should you, sitting in your living room in Chicago, or London, or Toronto, care about the JOLTS report? Because this is the canary in the coal mine for 3 major asset classes: stocks, real estate, and your cash. 1. The stock market. Wall Street has priced in a soft landing. The S&P 500 is trading at high valuations because investors believe earnings will grow in 2026. But if the labor market is freezing, wage growth slows. If wages slow, the American consumer, who makes up 70% of GDP, stops buying iPhones, stops buying Teslas, and swaps Starbucks for instant coffee. This margin compression hasn't been priced in yet. We are looking at a potential correction in consumer discretionary stocks. If you are heavy in retail, luxury goods, or travel stocks, you are standing on a fault line. The silent freeze means revenue misses are coming. 2. Real estate. This is where it gets tricky. You might think a bad job market crashes housing prices. Not necessarily. With the Fed cutting rates in late 2025, mortgage rates have likely dipped slightly. But if banks see the job market deteriorating, they tighten lending standards. We are entering a period of the golden handcuffs. People who have jobs won't sell their homes because they have cheap mortgages from 2020 to 2021. People who want to buy homes can't afford them because prices haven't crashed, but their wages have stagnated due to the hiring freeze. This leads to a transaction volume crash. Real estate agents, title companies, and mortgage brokers are going to starve. If you are investing in real estate, cash flow is king. Do not bet on appreciation in 2026. The liquidity is drying up. 3. The Vibrecession returns. We saw this in 2023 and 2024. The GDP says the economy is growing, but everyone feels broke. In 2026, this feeling is validated by the job market. Even if you have a job, the fear of losing it increases. When the vacancies to unemployed ratio drops below 1, leverage shifts to the employer. Return to office mandates will get stricter. Bonuses will get smaller. The quiet quitting era is over, the quiet firing era has begun. So, where do we go from here? As we look at the rest of 2026, there are 3 scenarios you need to prepare for. Scenario A, the miracle soft landing. The Fed pauses rates in January, the lag from the 2025 cuts kicks in, and hiring picks up in the spring. The silent freeze thaws, and we get back to a balanced market. This is what Wall Street is betting on. It's the optimistic view. Scenario B, the stagnation trap. This is the most likely outcome. We drift. The economy doesn't crash, but it doesn't grow. We enter a zombie economy. Companies don't fail, but they don't expand. The stock market trades sideways for 18 months. Your portfolio does nothing unless you are in high-yield dividend stocks or bonds. Inflation hovers at 2.5%, slowly eroding your wealth while your paycheck stays flat. Scenario C, the capitulation. The labor hoarding strategy fails. Companies realize the Fed cuts aren't stimulating demand fast enough. Corporate debt walls hit. That silent freeze turns into loud layoffs. If we see unemployment tick up from 4% to 5.5% rapidly, the psychological dam breaks. Consumption collapses. The Fed panics and cuts rates to zero. This is the buying opportunity of the decade, but you have to have cash on the sidelines to take advantage of it. Listen, I'm not here to be a doomer. I'm here to be a realist. The JOLTS data of January 8, 2026, is a signal. The signal says the power dynamic has shifted. The labor shortage is over. The labor surplus is beginning. For the last 3 years, the biggest risk to the economy was inflation, prices going up too fast. For 2026, the biggest risk is deflationary stagnation, growth stopping entirely. What should you do? 1. Audit your career. If you are in a vulnerable sector, shore up your position. The hiring market is closed. Do not quit your job without a signed offer letter in hand. 2. Audit your portfolio. Look at your exposure to consumer cyclical stocks. Are you betting on the American consumer spending more money this year than last year? Because the data says they won't. Pivot toward quality companies with cash moats, healthcare, and defense. 3. Watch the Fed. Later this month, if they hold rates steady, watch the language. If they sound scared about the labor market, the market will tank. If they sound confident, we might rally. The silent freeze is here. It's not flashy like a market crash, and it's not loud like a bank failure. It's a slow constriction of the economic airflow. Don't let your portfolio suffocate. Stay liquid, stay alert, and don't fight the data. I'll see you in the next one.